Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BAUSCH Health Companies INC quarterly report. BAUSCH Health Companies Inc. offers a diverse range of products and services across various segments. The company's business includes gastroenterology products through the Salix segment, aesthetic medical, devices through the international and Solta medical segments, branded pharmaceuticals, generic pharmaceuticals, and OTC products through the international segment neurology and dermatology, products through the diversified segment dentistry, products through the diversified segment vision care, surgical, and ophthalmic pharmaceuticals, products through the Bausch plus Lomb segment. BAUSCH Health Companies Inc.'s stock price drop. A year of concerns in the past year. BAUSCH Health Companies Inc.'s BHC stock price has plummeted by over 28.15%. Several key events and ongoing concerns have contributed to this decline. The company's substantial debt burden, reported at $21.5 billion in Q3 2024, remains a persistent concern for investors. Although Bausch Health undertook a $7.9 billion debt refinancing in April 2025 and announced a $900 million debt reduction in July 2025, the colossal debt continues to weigh on shares. Missed earnings expectations have also played a significant role in the stock's decline. In Q1 2025, Bausch Health reported lower than expected results, leading to a 3.81% decline in shares. The company's uncertainty regarding the separation and share distribution of its eye health business, Bausch plus Lomb, has further impacted investor sentiment. These factors have overshadowed positive developments, such as a legal victory in the Salix v. Norwich Xifaxan lawsuit in April 2024. Despite these gains, the stock's lowest price in the past 12 months was $4.25, and its highest was $9.85. As of October 30, 2025, the stock had decreased by 28% in the last 12 months. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, product sales, licensing agreements, and acquisitions have been significant contributors. The sale of branded pharmaceuticals, generic and branded generic pharmaceuticals, OTC products, and medical devices has driven revenue growth. Licensing agreements, such as those related to the DURECT acquisition, have also generated potential future milestone payments. In addition, higher volumes and improved net realized pricing across various segments have contributed to revenue growth. The Bausch plus Lomb segment, Salix segment, and Solta medical segment have been notable drivers of growth, with increases in volume, favorable foreign currency impacts, and incremental sales from acquisitions. On the decline side, loss of exclusivity for certain products has led to generic competition and significant decreases in product sales. Entry of generic competitors into the market for branded products has also contributed to revenue decline. Declines in pricing and sales volume of certain products, as well as reductions in revenues due to returns, allowances, and chargebacks, have further impacted revenue. Overall, a company's ability to adapt to changing market conditions, manage product life cycles, and navigate competition will be critical in driving revenue growth or mitigating decline. Net income and profit margins have undergone significant changes in 2025 compared to 2024. Net income increased by $273 million in Q3 and $393 million YTD, but decreased by $53 million due to the amortization of intangible assets no longer being a factor. Profit margins also saw notable improvements. Operating income margin rose from 13% in Q3 2024 to 23% in Q3 2025, while net income margin increased from -4% to 7%. However, some segments experienced declines. Salix segment profit margins decreased from 67% to 74%. International segment profit margins dropped from 33% to 31%, and Bausch plus Lomb segment profit margins fell from 23% to 20%. The reasons for these changes are multifaceted. Higher revenues contributed to the increase in net income, while a decrease in amortization of intangible assets also played a role. Additionally, lower asset impairments and other expenses helped boost profits. However, increased selling, advertising, and promotional expenses due to MIEBO, as well as economic conditions and macroeconomic factors such as inflation and interest rates, had negative impacts on certain segments. Ongoing litigation and uncertainty around the Bausch Health separation transaction also contributed to these changes. The company's financial performance indicates a positive trend in its operating cash flow. In 2025, the company generated $1,454 million in operating cash flow, a slight increase from $1,342 million in 2024. Additionally, net cash provided by operating activities reached $905 million in 2025, further demonstrating the company's ability to generate positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past few years. The total liabilities decreased from $26,845 million to $26,468 million on page 4, but increased by $20,529 million as of September 30, 2025, page 67. Additionally, the fair value of long-term debt increased from $18,243 million to $19,722 million, page 26, and new debt was issued under the 2030 Senior Secured Credit Facilities, page 37. The interest expenses have also seen a significant increase. The weighted average stated rate of interest increased from 7.72% to 8.57%, page 43, and interest expense increased by $66 million, 19%, from $346 million to $412 million, page 77. Furthermore, interest expense has increased significantly by $156 million, or 15%, from $1,051 million to $1,207 million, page 86. Overall, the company's debt level and interest expenses have changed significantly over the past few years, with both increasing in various instances. The company's financial performance varied across different segments and regions in the given period. The Salix, Solta Medical, and Bausch plus Lomb segments performed well with revenue growth rates of 12%, 25%, and 7% respectively. In contrast, the international and diversified segments experienced declines of 2% and 4% in revenue. Regionally, the North region generated $7 million in revenue and $3 million in profit, while the West region led with $8 million in revenue and $5 million in profit. The Bausch plus Lomb segment's profit decreased by 9%, indicating a decline in performance despite its initial revenue growth. Overall, the company's financial performance was mixed, with some segments and regions performing better than others. Management is optimistic about the company's future prospects following the B plus L separation. They believe this separation will allow each company to focus on its core businesses, driving additional growth and more effective capital allocation. To achieve this, they plan to allocate resources through strategic acquisitions, R&D investment, licensing agreements, and infrastructure investments. In terms of specific strategies, management aims to bolster the glaucoma treatment portfolio through acquisitions and expand presence in the dry eye market. They also intend to simplify operations by divesting non-core assets and improve patient access through pricing actions and assistance programs. However, management acknowledges that a potential recession may impact revenues, expenses, and margins, but they are preparing for this scenario by separating the eye health business and streamlining operations. Acquisitions and divestitures overview. The company has made several significant acquisitions and divestitures over the years. Key acquisitions include in-process research and development valued at $100 million shower-to-shower body powder product from Johnson & Johnson in September 2012. Acquisition of DURECT. Notable divestitures include B&L spinoff, valued at $1,698 million. Separation of eye health business, Bausch plus Lomb, transfer of talc liabilities to LTL Management, LLC in subsequent bankruptcy filing. The company's financial summary reveals that they have engaged in two key shareholder return initiatives. Firstly, the company has a history of paying dividends to its shareholders, as mentioned on page 41. Secondly, they have also invested in share buybacks, which is detailed on page 36. This demonstrates the company's commitment to rewarding its investors through both cash and equity returns. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights concerns regarding inventory buildup and supply chain disruption. Specifically, pages 26 and 85 mention inventory buildup as a concern, while page 78 indicates potential issues through returns provision balances. Additionally, the voluntary recall of Envista intraocular lenses on page 71 led to enhanced inspection protocols and resupplying of inventory, suggesting supply chain disruptions. Furthermore, page 107 notes that changes in inventory levels are a concern. These points collectively indicate that the company is facing challenges related to managing its inventory and supply chain. That concludes the financial summary for BAUSCH Health Companies INC. Feel free to comment below, and I will be happy to answer them when possible.